Morning, everyone. Today I want to talk about a topic that looks simple but is very important in cost accounting inventories. When we hear the word inventory, we usually think about warehouse full of product costs or long lists of items. But in cost accounting inventories mean much more. They represent the resources a company needs to work, to produce, and to sell. In other words, they are the base that helps control costs and give good decisions. Why are inventories so important? Because they answer key question. What do we have available? In which stage of production is it? And how much does cost to keep it? With this information, a company can plan better, avoid losses, and understand its profits more clearly. In cost accounting, we mainly talk about three types of inventories: raw materials, the basic import inputs before productions, work in process, product that are already being made but not yet finished. Finished good product ready to sell to customers. Each type of inventory shows a different stage in productions and how costs change step by step. To finish, know about inventories is not only about keeping records, it's about having a clear picture of how events a company is, how well it can respond to demand, and how sustainability in the long run.
Continued introduction from our colleague Andre. Topic: raw material inventory. Cost accounting perspective. In cost accounting, raw material inventory refers to the basic inputs a company purchases to begin the production process. According to Charles T. Hungren, this inventory is one of the three key types, alongside with a work in process and finished goods that take up manufacturers' total inventory. Raw materials are stored until they are needed for production. Managing this inventory efficiently is crucial for controlling costs and ensuring smooth operations when raw materials are purchased. They are recorded as assets on the balance sheet. Only when they are used in production do they become part of the cost of goods manufactured. Hongren emphasizes that the importance of accurate tracking. Companies must monitor quantities, costs, and usage rates to avoid overstocking or shortage. This includes applying inventory valuation methods such as FIFO, first in, first out, LIFO, last in, last out. Ultimately, raw material inventory is not just about storage. It's about aesthetic strategy control by understanding how materials flow into productions. So we have a nice and lovely entrepreneur about controlling all the stuffs.
Good. Hello, my name is Ismenia. Words in process inventory mix products that a company has already started making, but they are not finished yet. For example, imagine a factory that make chairs. Sometimes chairs are complete and ready to sell, but others are still in the process. Maybe the legs are ready. But the thing is missing or the chair is painting but not dry. All of those in fines share are down the words in process. The inventory is important because it shows how much money the company is investing in products that are not ready to sell, it including the close material, the cost or work time, and other costs used to far. When the work is finished, the products moves from for work in process inventory to finished good inventory meeting already customers. When the works finish, the products move from works in process inventory to finished good inventory meeting already to customer. So, in sample words, in process inventory, it like the between start no rate material not finished product, but it's something in the middle.
Hello, my name is Liz Gutierrez, and today I am going to talk about finished goods inventory. This type of inventory includes products are already complete and ready to be sold to customers. They are 100% finishes. They include all production costs and they stay in storage until they are delivered or sold. Finished goods are very important because they help the company meet customers' demand quickly, represent a big investment, and if managed well, prevent losses. For example, in a shoe company, their pairs of shoes already packed and ready for sale are considered finished goods inventory. In short, finished goods inventory is essential because it shows the final result of productions and allow the company to generate income.
Greetings, my name is Anthony Chavez, and I'm going to talk about indirect materials inventory. This refers to the supplies a company keeps on hand that are necessary for production but cannot be directly traced to a specific product. Unlike raw materials, which become part of the finished product, indirect materials are used in the process, but in small or supportive ways. Examples include lubricants for machines, cleaning supplies, or small tools. In cost accounting, these materials are classified as part of manufacturing overhead. Companies track them carefully to avoid waste, ensure smooth operations, and assign costs accurately. Proper control of indirect materials inventory not only helps maintain efficiency on the production floor, but also improves the accuracy of product costing and overall financial management. In summary, inventories in cost accounting give us a clear picture of how resources move, move to a business. Raw materials inventory shows the basic inputs waiting to be used. Work in progress reflects items still being produced, and finished goods represent products ready for sale. Indirect materials inventory, on the other hand, covers the small but essential items that support production without being part of the final product. Together, these categories help managers control costs, plan production, and make better financial decisions. Understanding them is key to managing efficiency and profitability in any organization. That's all for today, and thank you very much for your attention.